Hello everybody. This time we are talking about corporation. A corporation is a legal entity that is separate and distinct from its owners and is established to conduct business or trade. It files tax returns with the Internal Revenue Service or IRS. Corporations are formed by individuals who file articles of incorporation in the state where they intend to operate. Corporations can enter into contracts, loan and borrow money, sue and be sued, hire employees, own assets, and pay taxes. Importantly, corporations offer their owners limited liability protection. Their shareholders profit through dividends and stock appreciation, but they are not personally liable for the company's legal or financial liabilities. And then we move to the main types of business incorporations. The first types, C corporation. C corporation is the most common form of incorporation among businesses and contains almost all of the attributes of a corporation. Owners receive profits and are taxed at the individual level, while the corporation itself is taxed as a business entity. And then the second, S corporation. S corporation is created in the same way as a C corporation, but is different in owner limitation and tax purposes. An S corporation consists of up to 100 shareholders and is not taxed as separate. Instead, the profits or losses are sold by the shareholders on their personal income tax returns. And then, third, non-profit corporation, commonly used by charitable, educational, and religious organizations to operate without generating profits. A non-profit is exempt from taxation. Any contributions, donations, or revenue received are retained in the entity to spend on operations, expansion, or future plans. And then we move to K characteristics of a corporation. The first characteristic, legal entry, recognized by law as an individual entity separate from its owners. And then second, centralized management structure, operates under a defined management structure with a board of directors. And then the third, limited liability. Shareholders are typically not personally liable for the corporation debts. And then fourth, transferability of shares. Ownership shares can be transferred among shareholders freely. And fifth, perpetual succession exists independently of its shareholders, ensuring continuity. And then, how does corporation work? The first, about formation. Incorporated under an enactment to get a registration certificate and tax identification. And then second, profits and dividends. Profits are reinvested in expansion or paid to shareholders. And then the third, ownership and shareholders. Investors purchase shares in order to own part of the company. And then fourth, legal compliance. Must comply with corporate laws, pay taxes, and file financial reports. And then fifth, management structure. It is run by a board of directors who appoint managers. And sixth, operations and decision making, controlled by executives with the board's supervision. And finally, seventh, raising capital, may issue stocks and bonds to finance business operations. And then we move to benefits of incorporating. The first benefit, limited liability. One of the most well-known advantages of forming a corporation is that they offer personal liability protection to shareholders. This means that owners are generally only liable for the amount that they've invested in the company. Shareholders' personal assets are generally protected. And then, second, tax benefits. Some corporation types, like C Corps, are subject to double taxation, but under corporation structures come with many tax advantages. For example, for many corporations, owner-paid health insurance premiums are tax deductible. Another benefit is that corporate shareholders are not subject to self-employment tax on income. They pay tax on this can result in significant savings as compared to other entity types. And then third, unlimited life and transferable ownerships. Corporations have an unlimited life and transferable ownership. If an owner passes away or decides to sell their share of the company, the business will continue to exist with the option of transferable ownerships. Owners can sell or pass shares to another person or businesses. And then we move to the difference between a partnership and a corporation. Many small business owners find themselves having to choose between forming a partnership and a corporation. The biggest difference between the two is that a partnership is not a separate legal entity and not a legal person. It is a pass-through entity. This has several consequences. While a partnership does come with rights and responsibilities, the general partners owning the business are held liable for all company debts and legal responsibilities. In other words, the assets of the general partners will be taken to pay company debts in the case of an insolvency. Taxation differs too, since any profit or loss passes through to the general partners in partnerships do not have to pay business taxes. Partnerships have to file a tax return with the IRS to report a profit or loss, which is also where the general partners must include their results. Further advantages compared to corporations and that partnerships are cheaper and simpler to form. Partnerships are also often accompanied by partnership agreements, which clearly state the percentage that each general partner has contributed and is responsible for. I think it is enough. Thanks for watching.